Hey everyone, welcome back to the channel. This is video 3 of our 4-part series on Procter & Gamble. In our first video, we talked high level about the company and calculated their WACC, which came out to about a 4.2%, which is what we'll be using as the discount rate in our DCF. In the second video, we took a look at their revenue by segment and forecasted that out for the next decade. We have it growing from about 71 billion in 2020 to 97 billion in 2030, which we can see right here. Now, in this video, we're going to be taking a look at their COGS and how the mix of revenue will play into the change in overall margins for the company. So in order to calculate margins by segment, we had to make a few assumptions, but we'll go ahead and walk through those now. So the first thing we needed to do was take our sub-segment level revenue, which we projected out in the last video, and we need to kind of bring it up one level. So they report out in 5 segments, and I will show you the tables they provide in their 10K. They provide us net earnings and net sales at this level: beauty, grooming, healthcare, fabric and home care, baby and feminine, and family care. And we projected revenue out one level below this. But what we can see is they actually provide us a table in their 10K as well that shows us, of these 5, what are the subcategories within that. So based off this information, we're able to take this sub level of revenue, and what I've done here is, you can see, brought it in based off that. So H66 plus H67. So if we look at that, that would be skin and personal care and hair care would make up their beauty segment. So now that we have that done, what we need to do is we need to calculate, because they give us net sales, we need to calculate everything above net sales, or sorry, above net earnings, but below COGS. So if we look at their income statement, what that is going to be comprised of is going to be SG&A, other expenses, and income taxes. So in order to do that, I've calculated here just one line. That's income, that's SG&A, tax, and interest income. And this is all coming off the income statement, but you'll see that's the sum up here. So what we need to do now is we need to actually break this out to each segment. In order to do that, we're going to do it as an approximation as percent revenue. So we are going to assume that SG&A costs are allocated proportionally to the business based off revenue. While this is not going to be 100% accurate, it is the best we have, or the best available information we have, to be able to make an assumption here. So what we'll do here, if you look at this SG&A, tax, and interest, what you're going to see is it's going to take C2, which is going to be this total company-wide cost, and then we're going to multiply that by the beauty revenue divided by the revenue of the entire company. And that'll get you the proportion of SG&A costs, tax, and interest that belong to the beauty segment. Once we have this completed, we can now go ahead and calculate COGS. So in order to do that, we'll look at the formula here, and it's going to be net sales less net earnings less SG&A, and that remaining amount is going to be your COGS. And what we can do now that we've calculated that for all the subsegments here, we can actually go ahead and look at COGS as a percentage of revenue and see how it's changed for each segment from 2016 to 2020. So we can see for beauty going from 40.5 to 47.1. Grooming has increased slightly. Healthcare increased slightly. Fabric and home care increased 4%, pretty dramatically. Baby, feminine, healthcare has actually decreased. And then other is kind of all over the place. This is really kind of a plug to make sure everything ties. So what we're going to do in our assumptions, or in our analysis, is we're not going to assume any improvements to margins for any of the subsegments of the business. This is a factor you could definitely come back and adjust and change it, and it will change the overall valuation of the business. But we're going to be leaving the margins, or the COGS percentage, flat and just letting them flow through based off the new percentage of total revenue for that segment. This is going to cause a mix issue, and you'll see this sometimes referred to in a 10K. You'll see them mention product mix. And what this really means is just based off the mix of revenue. So whether it's more beauty, grooming, healthcare, fabric and home care, baby, feminine, healthcare, whatever is kind of the larger piece here, it's going to have a different margin, and it's going to impact the company's total COGS based off a revenue mix. So once we go ahead and have this calculated and we've kind of layered this out, so you'll see we've held all the COGS percentages just flat to 2020, we can calculate our total COGS for the company now. And you can see we're going from 49.7% up to 50.3%. So based off our mix of revenue, our margins are actually slightly increasing. And the big thing here really is if we look at it, we do have their fabric and home care revenue growing, and it is obviously the highest COGS piece. So as this continues to grow, it becomes more and more of the revenue. And then on the opposite end of the spectrum here, we have their, where is it? Um, their grooming decreasing in revenue because they've been kind of struggling in the shaving area. And because of that, and this is a lower, COGS percent of revenue business, right? Kind of the opposite effect there. So you do end up seeing COGS as a percentage of revenue slowly increasing over the next decade. So this will do it for our video on margins. In our next video, we're going to go ahead and complete the DCF, and we're going to finalize a few assumptions around R&D costs and advertising expense. And then we'll see what kind of valuation we end up with. Thanks for tuning in. Let me know if you have any questions or comments, and feel free to leave them below, and I'll get back to you. Thanks so much.